Imagine sitting down for coffee, excited to talk about your dream home, and a friend casually drops a bombshell, that legendary mortgage interest deduction everyone talks about? It might be practically gone. Or rather, it's changed dramatically. This isn't about scare tactics, it's about unlocking the real story behind a tax break that once shaped American homeownership, and understanding how can navigate its shifting landscape today. We are going to journey through its past, confront its present, and equip you for a financially empowered future. Let's peel back the layers and uncover an unexpected truth about one of America's most iconic tax benefits. For generations, the dream of owning a home has been a cornerstone of the American experience. It's a vision of stability, a place to build memories, and often, a significant step toward financial security. But let's be honest, that dream comes with a substantial price tag. The monthly mortgage payments, the interest accumulating over decades, it's a commitment that can feel overwhelming. People have long sought ways to ease that burden, to make homeownership more accessible and sustainable. This aspiration set the stage for one of the most powerful tax incentives ever created, promising a tangible pathway to financial freedom. Our story begins way back in 1913, when the modern income tax was first introduced. Even then, lawmakers recognized the importance of encouraging homeownership. They understood that easing the financial strain of interest payments could make a profound difference. So, they created a provision, a quiet helping hand, that allowed homeowners to deduct the interest they paid on their mortgages from their taxable income. It wasn't just a simple tax break, it was a national embrace of the homeowner, a clear signal that this investment in one's future was worthy of support. This deduction quickly became deeply woven into the fabric of American finance. The original intent behind the mortgage interest deduction was clear: stimulate homeownership and make housing more affordable. Imagine a young couple in the mid-20th century, saving diligently for their first home. The prospect of reducing their taxable income by deducting their mortgage interest would have been a powerful motivator. It lowered the effective cost of borrowing, effectively putting more money back into their pockets. This wasn't just about individual gain. It was seen as a way to build stronger communities and a more stable economy. It was a forward-thinking policy designed to uplift millions, empowering them to invest in their own futures and contribute to the nation's prosperity. At its heart, the mortgage interest deduction is quite simple. When you take out a home loan, a significant portion of your early payments goes towards interest, not the principal. This deduction allows you to subtract that interest amount from your adjusted gross income before calculating your federal income tax. Think of it like this: if you earn $70,000 and pay $10,000 in mortgage interest, your taxable income could potentially be reduced to $60,000. This reduction can lead to a lower tax bill, freeing up more of your hard-earned money. It's a powerful tool, transforming a substantial expense into a strategic financial advantage. To claim the mortgage interest deduction, you must itemize your deductions on your federal tax return. This is where the story gets interesting. Instead of taking the standard deduction, a fixed dollar amount offered to most taxpayers, you're choosing to list out specific eligible expenses, like mortgage interest, state and local taxes, and charitable contributions. It's a deliberate choice, and one that requires a bit more effort in record keeping. But for many, especially those with significant eligible expenses, itemizing unlocks substantial tax savings, rewarding diligence with real financial gains. It's about taking control of your tax destiny. This brings us to a crucial turning point for every taxpayer: choosing between the standard deduction and itemized deductions. It's like deciding between a well-worn, comfortable path and a more adventurous, potentially rewarding trail. The standard deduction is simple, a fixed amount based on your filing status. Itemizing, however, demands more work, tallying up every eligible expense. You only benefit from itemizing if your total itemized deductions exceed the standard deduction amount. This decision is fundamental, shaping the tax landscape for millions of homeowners. Understanding this choice is the first step in maximizing your tax benefits. Before 2017, the mortgage interest deduction was a powerhouse for many. With relatively lower standard deduction amounts, a large number of homeowners found it advantageous to itemize. This was especially true for those with larger mortgages in higher cost areas. They could combine substantial mortgage interest, state and local taxes, and other deductions to easily surpass the standard deduction threshold. It was a compelling financial incentive, driving real estate markets and providing significant relief to millions of taxpayers. The benefit was clear, tangible, and widely accessible, fostering a sense of financial uplift for homeowners across the nation. Let's meet Sarah. In 2016, she purchased her first home with a substantial mortgage. Each year, she meticulously calculated her itemized deductions: $12,000 in mortgage interest, $8,000 in property taxes, and a few thousand in charitable donations. Her total easily exceeded the standard deduction for a single filer at the time, which was around $6,300. This meant a significant chunk of her income was shielded from taxes, making home ownership feel a bit more achievable. Sarah felt empowered, seeing her investment in her home translate directly into real tax savings. She embraced the system, confident in her financial foresight. Then came the plot twist, a dramatic turning point in our story: the Tax Cuts and Jobs Act, TCJA, of 2017. This sweeping legislation reshaped the tax landscape, and the mortgage interest deduction was right in its crosshairs. The goal was broad tax reform, but its impact on individual deductions was profound and immediate. For many homeowners, the rules of the game fundamentally changed. What was once a reliable and accessible benefit suddenly became more exclusive, leaving countless individuals to reevaluate their financial strategies. It sent ripples of uncertainty through the housing market and into the homes of millions. One of the most impactful changes brought by the TCJA was a significant reduction in the amount of mortgage debt eligible for the interest deduction. Previously, you could deduct interest on up to $1 million of acquisition debt. After TCJA, for new mortgages taken out after December 15, 2017, this cap plummeted to $750,000. This was a monumental shift, especially for homeowners in high-cost housing markets where mortgages often exceed this new threshold. It meant less interest could be deducted, directly impacting the potential tax savings. This new reality forced a reassessment for anyone considering a new home loan. But the TCJA didn't just target the mortgage interest deduction. It also dramatically increased the standard deduction amounts for all filing statuses. For example, the standard deduction for a single filer jumped from $6,350 in 2017 to $12,000 in 2018. For married couples filing jointly, it nearly doubled to $24,000. This massive increase was a deliberate move to simplify taxes for many Americans. While beneficial for some, it meant that fewer people would find it advantageous to itemize their deductions, even if they had mortgage interest. This surge in the standard deduction became a silent, yet powerful, equalizer. The combination of a lower mortgage interest cap and a soaring standard deduction created a perfect storm for many traditional itemizers. Suddenly, their total itemized deductions, even with mortgage interest, often fell below the new, higher standard deduction. This meant they would claim the standard deduction by default, effectively nullifying the benefit of their mortgage interest deduction. The change was disheartening for those who had relied on this tax break for years. It required a significant recalibration of financial planning and expectations, emphasizing the dynamic nature of tax laws and the need for constant vigilance in managing your money. Here's what most people get wrong. They assume they still automatically qualify for the mortgage interest deduction and that it will significantly lower their taxes. They hear about it from friends, or remember how it worked for their parents, and don't realize the rules have fundamentally shifted. The deduction isn't gone, but for a vast majority of homeowners today, the increased standard deduction means they won't itemize, and therefore won't claim their mortgage interest. This widespread misconception can lead to missed opportunities for genuine tax planning and, more importantly, a misunderstanding of one's true financial picture. Don't let assumptions guide your financial journey. Why does this matter so much for your money and your life? Because every dollar you save on taxes is a dollar you can put towards your goals, paying down debt, boosting your emergency fund, investing for retirement, or even planning that well-deserved vacation. A clear understanding of the mortgage interest deduction's current role helps you make informed financial decisions. It prevents you from overestimating your potential tax refund and guides you towards strategies that actually benefit you, rather than clinging to outdated assumptions. This knowledge empowers you to optimize your finances, taking charge of your present and building a stronger future. So, When does your mortgage interest actually count towards a deduction you can use? Fundamentally, it applies to interest paid on a mortgage secured by your main home or a second home. The key is that the loan must be secured by the property itself. This means your primary residence and one additional property, perhaps a vacation home, can potentially qualify. It's about establishing a clear connection between the debt, the interest, and a qualifying residence. This foundational understanding is crucial, forming the bedrock of any successful claim and ensuring you stay within IRS guidelines. Let's expand on that. The deduction applies to interest on debt used to buy, build, or substantially improve your principal residence and one other qualified home. What defines a qualified home? It's a house, condo, co-op, mobile home, boat, or similar property that has sleeping, cooking, and toilet facilities. It doesn't have to be used purely for personal purposes. You can rent it out for part of the year, but strict rules apply to how much personal use you have. This flexibility offers a broader scope for homeowners, allowing more paths to potential tax savings and financial optimization. The most important type of mortgage debt for this deduction is acquisition debt. This is the money you borrow to buy, build, or substantially improve your main home or second home. Think of it as the core loan that directly facilitates home ownership. If you take out a mortgage to purchase your house, that's acquisition debt. If you then renovate your kitchen and add a new wing, borrowing money specifically for that also qualifies as acquisition debt. This focus ensures the deduction primarily supports direct investment in the property itself, aligning with its original purpose of encouraging home improvement and ownership. Before the TCJA, homeowners could deduct interest on up to $1 million of acquisition debt. This was a significant amount, encompassing most mortgages across the country, even in relatively expensive areas. It allowed substantial deductions for those pursuing larger homes or living in high cost of living regions. This $1 million cap was a generous threshold that provided broad relief, fostering a sense of financial stability and encouraging investment in more significant properties. It was a simpler time for many, with fewer complexities to navigate and a clear path to realizing substantial tax advantages. Today, for mortgages taken out after December 15, 2017, the maximum amount of acquisition debt on which you can deduct interest is $750,000. This is a critical distinction and the core of the TCJA's impact on this deduction. If your mortgage is $1 million, you can only deduct interest on the first $750,000. This means a portion of your interest payments effectively becomes non-deductible. Understanding this cap is paramount, especially for those contemplating new home purchases or substantial renovations, as it directly shapes the real financial cost of borrowing. It's a challenge to be aware of, but also an opportunity to plan proactively. However, there's a silver lining, a small victory in this story, a grandfather clause. If you took out your mortgage on or before December 15, 2017, the old $1 million acquisition debt limit still applies to you. This is a crucial detail that often gets overlooked. These old mortgages are shielded from the new, lower cap, preserving their original deduction potential. So, if you're one of these homeowners, you might still reap significant benefits. This clause offers a moment of relief and continuity amidst sweeping changes, reminding us that sometimes, looking back can reveal unexpected advantages. The TCJA also dramatically reshaped the landscape for home equity loans and lines of credit, HELOCs. Prior to 2018, interest on these loans was generally deductible, regardless of how you use the funds. This meant people could use a HELOC for anything from debt consolidation to vacations and still deduct the interest. But the rules have tightened significantly. Now, for the interest to be deductible, the home equity loan must be used to buy, build, or substantially improve the home that secures the loan. This change means you can no longer deduct interest on home equity debt used for personal expenses, making a clear distinction crucial for savvy homeowners. This distinction between home equity debt and acquisition debt is vital. While a home equity loan can become acquisition debt if used for qualified home improvements, it doesn't automatically qualify. If you take out a HELOC to, say, pay off student loans or fund a wedding, the interest is no longer deductible. This is a common pitfall that can lead to unexpected tax bills. The IRS is precise. The *U of the funds dictates deductibility. So, Before tapping into your home equity, pause and consider the purpose, aligning your borrowing with your tax strategy. This conscious choice empowers you to maximize your financial leverage. Let's illustrate with quick examples. Imagine you take out a $50,000 home equity loan. If you use that $50,000 to add a much-needed bedroom to your home, the interest on that loan can be deductible, assuming it falls within the overall $750,000 acquisition debt limit. However, if you use that same $50,000 to consolidate high-interest credit card debt, the interest is not deductible under current law. This seemingly small detail carries significant financial weight. It's a clear demarcation that demands your attention, guiding your choices toward tax-advantaged financial behaviors and away from common errors. What about refinancing? This presents its own riddle. When you refinance your mortgage, the interest on the new loan is generally deductible, but only up to the amount of the original mortgage principal plus any additional funds used for home improvements. If you take out a larger loan during a refinance and pocket the extra cash for non-home-related expenses, the interest on that cash-out portion is not deductible. It's crucial to understand the purpose of every dollar you borrow. Unraveling this riddle allows you to confidently navigate your refinancing journey, ensuring every financial move is optimized for your benefit. Beyond regular interest, you might also deduct points or loan origination fees. When you purchase or refinance a home, these are often paid upfront to secure a lower interest rate. Generally, points paid on a loan to buy or build your main home are fully deductible in the year you pay them. For refinances, points usually must be deducted over the life of the loan. This can add another layer of complexity but also another avenue for tax savings. Don't overlook these often forgotten deductions. They represent tangible opportunities to reduce your tax burden, rewarding your attention to detail and financial literacy. Your key document for claiming mortgage interest is Form 1098, Mortgage Interest Statement. Your mortgage lender sends this to you each year, reporting the total interest you paid during the tax year. It's your official record and the primary piece of evidence you'll need. This form also reports points paid, if any, and other relevant information. It's more than just a piece of paper. It's a direct link to potential tax savings, summarizing your financial story for the year. Always review it carefully to ensure accuracy, trusting in the power of precise documentation. Beyond Form 1098, meticulous record keeping is your best friend. Keep all your mortgage statements, closing documents, and any receipts for home improvements if you've used home equity debt for qualified purposes. These documents tell the full story of your mortgage journey and are invaluable if the IRS ever has questions. Being organized isn't just about avoiding stress. It's about having a clear, undeniable record of your financial actions. This proactive approach grants you peace of mind and builds a foundation of confidence in your tax filings, empowering you for any financial scrutiny. The power of good record keeping extends far beyond just the mortgage interest deduction. It's a cornerstone of sound personal finance. Knowing where your money goes, what you've spent, and what you've saved gives you incredible control and insight. For tax purposes, it means you can confidently claim every deduction you're entitled to, avoiding missed opportunities or potential audits. It transforms the often daunting task of tax preparation into a streamlined process, empowering you to approach your financial life with clarity and precision. This simple habit can unlock significant financial advantages over time. Here's a small drama that unfolds for too many: the unprepared taxpayer. Picture Sarah, after the TCJA, trying to file her taxes. She remembers the mortgage interest deduction from years past, but she hasn't kept up with the changes. She struggles to find her Form 1098, can't recall if her home equity loan was for renovations or vacation, and ultimately defaults to the standard deduction, missing a potential benefit she might have qualified for. This confusion, this missed opportunity, is a direct result of not staying informed and organized. Don't let this be your story. Be the hero of your own financial journey. Ultimately, the decision to itemize or take the standard deduction is deeply personal. It depends on your unique financial situation, your income, your mortgage size, your property taxes, and your charitable contributions. There's no universal right answer. For many, the increased standard deduction now makes itemizing a less attractive option. But for others, particularly those with very large mortgages in high-tax states or those who are incredibly generous with their donations, itemizing might still be the smarter move. It's about empowering yourself with knowledge to make the choice that best serves your financial goals. When considering itemizing, remember the state and local tax, SALT, deduction cap. The TCJA also limited the deduction for state and local income, sales, and property taxes to $10,000 per household. This significantly impacts homeowners in high-tax states, making it even harder to exceed the standard deduction threshold. So, when you add up your potential mortgage interest, property taxes, and charitable giving, be mindful of this $10,000 capital. It's another layer of complexity, but understanding it is key to accurately assessing your itemizing potential and maximizing your overall tax efficiency. What does the future hold for the mortgage interest deduction? Like many tax provisions, it's subject to political winds and changing economic priorities. The TCJA provisions are currently set to expire at the end of 2025, which means we could see further changes. There are always whispers of reforms, discussions about its equity, and debates about its effectiveness. Staying informed about these potential shifts is an act of financial vigilance. By keeping an ear to the ground, you can anticipate changes and adjust your strategy, ensuring your financial roadmap remains current and robust. It's vital to remember that the mortgage interest deduction is just one piece of a much larger financial puzzle. Don't let the pursuit of a tax break overshadow sound financial principles. Buying a home should be driven by lifestyle needs, long-term investment goals, and affordability, not solely by tax advantages. While understanding the deduction is empowering, your overarching financial health, managing debt, building savings, and investing wisely will always be paramount. This holistic perspective ensures that you make choices that genuinely serve your well-being, fostering a life of enduring financial strength and freedom. The journey we've taken today, exploring the story of the mortgage interest deduction, is truly one of financial empowerment. By understanding its history, its dramatic shifts, and its current realities, you're no longer just a passive participant in your financial life. You become an active architect, capable of making informed decisions, anticipating changes, and optimizing your resources. This knowledge isn't just about taxes. It's about building confidence, securing your future, and achieving your dreams with clarity and purpose. Embrace this power, for it is the foundation of lasting prosperity. So, what's your action plan? First, gather your 1098s and other relevant documents. Second, if you're unsure, consult a qualified tax professional. They can analyze your specific situation and help you determine whether itemizing is beneficial. Third, stay organized throughout the year. It makes tax time so much easier. Fourth, be proactive in learning about potential tax law changes. Don't wait for tax season to wonder. By taking these concrete steps, you transform complex information into actionable strategies, paving the way for a more secure and prosperous financial future. Start today and seize control. As we wrap up our coffee chat, remember this: your financial journey is uniquely yours. The mortgage interest deduction is just one chapter in a much larger, evolving story. By understanding its nuances, its past, and its present, you've equipped yourself with a powerful tool. You're ready to make informed decisions, to navigate complexities, and to build a future where you are truly in control. Every step you take in mastering your finances, no matter how small, contributes to a larger narrative of success and independence. Own your story, embrace the journey, and flourish.